Hi, I'm Mortgage Mike, and welcome to your weekly mortgage industry update. Today's topic is on Quantitative Easing II, or QE2. You probably heard about this in the news, and I want to talk to you about what that means from a mortgage perspective. So, what is Quantitative Easing II? QE2 is a program instituted by the Fed, and it has three goals. And those three goals, or stated goals, I should say, are to one, bolster the stock market or stock prices, two, lower unemployment, and three, create inflation. Now, there's a non stated goal here from the Fed, and that is they want to weaken the US dollar. So, what I'd like to do is look at these three goals from a weak US dollar perspective and what does that mean for us in regards to making mortgages, selling homes, and all that wonderful stuff in the real estate finance industry. So a weak U.S. dollar uh, helps the stock market by uh, increasing the demand for our goods abroad. Now, how does it do that? Well, when we have a weak U.S. dollar compared to other currencies, that makes our goods cheaper, which means that the demand for our goods goes up, which means that our multinational corporations make more money, which means that they put more earnings on their books, which in turn increases their stock price. Now, how does that inflect the employment rate? Well, as our demand for our goods and services increase, so will the demand for labor to create those goods and services. Now, we haven't seen that really in 2010 because corporations were stockpiling cash with all the uncertainty in the marketplace. They didn't know what to do or didn't really want to invest that money until they felt more certain about what was happening in the economy. But certainly, we can look at the economy right now and say we're on a good upward trend, and we should begin to see corporations investing in labor once again, which is a good thing for us in the housing industry because as people work, people buy houses. We like that. The third thing is creating inflation. The third goal is to create inflation. And boy, I think we're beginning to see that. We're beginning to see little bits of inflation here and there, and that's exactly what the Fed wants to accomplish. The interesting thing is we're seeing inflation globally. Look at China, the UK just recently announcing some inflation, Brazil. So it's something we have to be very careful with, inflation. We don't want it to run unchecked, or the Fed doesn't want it to run unchecked, but they certainly want to create inflation because inflation will spur investment. Instead of having corporations keeping their money on their balance sheets, it's going to spur investments because they're going to have to find places to make more money as inflation increases. So, with that being said, that is quantitative easing II. The unfortunate thing is it's not going to bode well for mortgage-backed securities and interest rates this year. However, we will have the third best interest rate year we've had on the books. So we'll see interest rates hover between probably 4 and 7/8 and 5.5 for this year. And those are fantastic rates. Think back to 2006, 2007. We were selling homes and interest rates were at the 6% range. So this is Mortgage Mike signing off, and I hope to see you next week. Talk to you soon.